With hard landing risks reduced this fall, the Fed cutting interest rates, business cycle indicators showing signs of life and the potential for an animal spirits rebound post the election, the path of earnings growth should be upward as we head through 2025. Mike joins us now for more. Mike, good morning.
Good morning.
It's good to see you. How unusually wide are the range of outcomes for 2025 for you and the team?
Well, it's about the same as it was in the mid-year. I mean, we've moved to this sort of view because the outcomes of the election, the economic outcome, rates, policy, et cetera, is also wider. So, we have to take that into account. And we did a pretty good job, I would say, this year of moving that around, meaning as the economic outlook changed through the summer into the fall. I mean, that's really the game now, is just trying to get ahead of these sort of pivots because it's going to remain uncertain. You all were just discussing the new cabinet positions. Yeah, I mean, they don't even know yet. They're going to try to figure this out. That's the challenge. And I think the markets are going to, as usual, trade that. So we're trying to do that as well for clients.
So your message to clients going into 25, be nimble. You've got some sector picks in there.
Yeah.
The overweight you like is financials. The underweight, the sector you don't like, the consumer. Both staples and discretionary. Can we start with the consumer? What's not to like?
Yeah, well, I mean, it's been weak. I mean, the consumer has been softer, and this fits into our sort of, our call we've had for a while, which is that the government has just sort of crowded out a lot of the economy, right? I mean, the low-end, mid-end consumer, low-end, mid-end businesses, quite frankly. So that's something we are now thinking about, right? This changeover, I mean, this is why Trump won. This is why the Republicans won. They want change. Consumers want change. So let's see if they can execute. But that's something that we have a short leash on now on the consumer side. I'd say we're looking to maybe upgrade certain consumer stocks if they can pull off some of these policy challenges that they're going to try to navigate. And look, I think on the financials, we've been overweight financials. It's been a terrific group. And the question there is how much further can it go? But look, once again, policy, deregulation, Basel III coming off. I mean, these things are all positive drivers that should continue to help that sector, at least on a relative basis.
Policy challenges and changes for the consumer. What changes would you need to see to upgrade a bigger cohort of those names?
I think that, once again, it's this crowding out thing. So this is a big picture view. But if they can shrink the government size, and by the way, this is going to take years. Okay, this is not going to happen in 6 months. And that's why we're not upgrading consumers yet. But if you're able to shrink the size of the government, kind of get them off the back of small businesses to some degree, this animal spirits thing is real. And then, of course, if you can get, the rate situation under control where term premium is balanced with the budget, those are the kinds of things that can actually spur consumer spending, consumer confidence, which has really been in the doldrums.
How much is it also tax policy? Essentially, if people pay fewer taxes, they can go out and spend more on Gucci.
Or anything else. I mean, quite frankly, the consumer has been having a hard time spending money on food. So let's start with that. Let's start with just getting inflation sort of under control. Getting people's confidence about the economy going forward and willingness to sort of look forward and spend on things, invest in things. I think one of the biggest areas that has really underperformed is consumer durables because rates are still too high. The level of rates are still too high. Now, I don't think we're going to be able to see rates come down any faster because of this administration, but over time, I think that's the key. If we can get rates down to a plausible level, wages increase to offset the inflation that's already in the economy, the consumer will fare better.
There are a lot of other questions like tariffs and how that could potentially affect some of these companies. But there's a broader point here, which is that specific sectors are going to respond very differently to policy changes going forward and don't necessarily have the same kind of macroeconomic overlay that they've had in recent years. And I wonder how much you're sort of seeing that play out. And I point to healthcare in particular because it's been one outlier over the past 2 weeks. You've seen it go down some 6% because of the overhaul that clearly is lining up with some of the picks for CMS and HHS. Do you lean into that, or do you see these as opportunities?
Well, there's both. I mean, there's going to be risk here, too. I mean, by the way, once again, the markets are very smart about this. They've punished big food companies because of perhaps Bobby Kennedy's appointment. Same thing for pharmaceuticals. So the bad news is sort of already getting priced in that regard. But the positive story in healthcare, quite frankly, is just an efficiency story. It's no different than the government. This is going to take years. If we can make the deployment of healthcare, the delivery of healthcare more efficient, that's going to create great opportunity for certain types of businesses. But this is to come, right? This is why we need to be nimble and think about, okay, it's not all going to happen at once. There's going to be moments of fear, doubt, and uncertainty, and that's going to create the opportunity, we think, through 2025.
You keep coming back to efficiency. Do you think Elon Musk and Vivek Ramaswamy could Dogify the economy?
I think there's a good chance that we can not necessarily cut all the spending they're talking about, but if we can just freeze spending. Remember, the key here is fiscal sustainability, which is just let's grow the government slower than we're growing nominal GDP. If you can get into that position, so Scott Bessent has said, this part of his plan, let's just get the fiscal deficit down to 3%. We're not talking about going to zero, but if we can just get it to 3%, that's in a much more sustainable place, which is one of the reasons why I think the bond market is reacting, at least initially, somewhat positively to this. One of the key negatives or risks that we see in the short term had been term premium. If term premium continued to widen out, that's a real risk for multiples. So I'm encouraged by the reaction initially, but I'm also not confident to say that this is going to be, it's a straight path from here to there.
What do you think the North Star is when all is said and done of this administration? Because you have things like tax cuts, but things like as well as tariffs, which in a blanket response, many economists say could be inflationary, but they ran on getting inflation down. Is that the number one key thing that Trump wants to make sure inflation comes down for Americans to afford groceries?
Well, I think that look, his mandate was prices are too high. There were probably three main issues. Prices are too high, unacceptable. Immigration, we've got to fix that. And then this idea of these never-ending wars and like spending money over like unnecessarily in many Americans' eyes. So he's going to try and take all three of those. It's kind of an America first policy with the sort of added twist that we're also going to try and redistribute the income in a way that's more taxing people and then distributing it that way is inefficient. If you can somehow reduce taxes and get the income redistributed at the wage level, that's really, really good. I think that would be the goal. Once again, it all comes down to execution.
When you say nimble and being nimble as an investor, are you saying trade frequently? Is this going to be the most active trading year that you can imagine for the team in 2025?
Yeah, I think that's a really good way to put it. I would say we've been more active in that regard, trading the underlying as opposed to focusing so much on the index. We are probably going to be offering more trades for clients. And when I say trade, it's not a day trade. It's 3 to 6 months, rotating around the portfolio in a way that is actually you can do that in size. Right? We're not going to say, hey, do these things that larger clients can't do. But 3 to 6 month trades is a lot faster than sort of a 12-month view.
Do you see the breakdown of correlations that have traditionally held true, whether it's with yields and the effect on stocks and some of the macroeconomic overlays? Are they going to become less relevant as there are these sort of rotating trades, 3 to 6 months that kind of go through sectors and specific names? No, I think they become more important. I think the macro will always play a role. I do hope and expect perhaps next year that we can see more micro opportunity. And what I mean by that is that because of the economy and the setup, that policy that we've had, by the way, this is not just the last 4 years, this is the last 20 years, this crowding out, right? It's the big get bigger, the have and have not, the K economy that everybody's sort of familiar with. That, to me, is going to be the key. Can we move from sort of a very narrow participation in the economy, both from a consumer and corporate standpoint, to something that's broader? If that happens, that's going to create more micro opportunity, but it doesn't mean you can ignore interest rates, other policy changes, because that's what's going to affect the micro opportunity.
Where does that leave the Mag 7? Some of these dominant companies?
I mean, I think you're already seeing it. It's like there's going to be more winners. It's going to be a separation of winners and losers there too. One thing we know about cycles over time is that the big winners of the last 10 or 20 years are not the big winners of the next 10 or 20 years. And so we've talked about this a lot. We've written about it. Like AI, to me, the big exciting part of AI is not the guys who are building AI today and the picks and shovels who have already won. It's the application layer. Who's going to develop and deliver the solutions that take advantage of this new compute platform to deliver the efficiency for corporate America for consumers, much like email did, or web browsers, or software as a service. I mean, you think about the big winners of the internet, it wasn't the carriers who spent all this money and put it in the ground. It was the companies that built the application layers to build better mousetraps going forward.
You wrote about some of this earlier this year. You said the focus at the moment of the equity market was on the AI enablers, which was the chips companies, the Nvidias of this world. Where are we in that process? Are we moving away from that yet?
Well, we're still in it. I mean, there's still companies are still benefiting, but that's all very narrow too, by the way. There aren't that many beneficiaries of the spend, which has been unusual. It's very different than the 90s where you had hundreds of beneficiaries. So I think we're still in that phase, and we're going to transition to now the adopter phase, like who can actually use this stuff, which so far is only the hyperscalers. Once again, the really exciting part is the ones who can actually take this platform, build applications, and then deliver it to dummies like me and make me more productive, right? Like just the average person to say, I don't need to be a technologist, but I understand how this application works and how it can make me more efficient in doing my job, which is, looking at stocks, in these mass quants of data in a way that I can actually understand and deliver it to clients.
We've known each other a while. I have to say, you sound pretty excited about next year in a way that I've not heard you for a long time.
Yeah, I mean, we're not always, one way. So I would say we've been excited about this for 6 months. It's just now we can kind of see it in a way where we can see a broadening out. We see it in the numbers, right? We've been waiting for this. So in the last 2 quarters, we've actually seen a broadening out of the earnings story for the first time, even before the election outcome. Okay, so this is a 2-step process. It's going to be, noisy. Stocks are expensive. Okay, that's something we have to understand. The markets are ahead of this already. Let's not think that we're discovering the light bulb here. Okay, the markets have already done this. So, but yes, I think there's a wider path now, a wider set of opportunities, which to me is more exciting.
You've spent a lot of time speaking to clients over the last few months, I'm sure, about the outlook for 2025. What are they most skeptical about? What's the biggest pushback you get?
Well, valuation has been, I've been skeptical on that, quite frankly. So it's still, people are uncomfortable with the valuation in the equity markets. But then when you think about, what else is there out there? And then you look at the U.S. versus other markets too. So that's probably the biggest one. The second one is just, it still feels unstable. Like geopolitics, the political, angst in this country is like not resolved. I mean, there's still this very bifurcated political environment. People's economic situations are very bifurcated. That makes people uncomfortable. So I think that's the part that people it's hard to get uber bullish when you have all these things that are kind of holding you back.
Do you sense that some clients, and of course you're not going to name any, but do you sense that some are finding it difficult to divorce their political bias away from their economic views? Have they learned the lesson of 2016-17?
I mean, most clients are more objective. Investment clients are more objective about that because they have to be, right? Because there's this thing called the price that makes them be objective about the outcome. That doesn't mean they don't hold personal biases. We all do. That's natural. I do think 2016 maybe changed that a bit, but look, we're all forced to perform. And whether it's a political bias or it's a style bias, you have to navigate that and be flexible.
Just to put a bow on this conversation, the essence of this conversation when you talked about the administration was the real potential for real change. When I asked you about whether some of these clients are skeptical about 2025, are they skeptical about anything in the administration's agenda that you think maybe they should be paying more attention to?
Well, we wrote about this weekend. I mean, there's a tremendous amount of skepticism on whether they can actually streamline the government because it's just, people have tried this before. This is not like a new idea, right? So it's difficult. And we all know about these roadblocks that are kind of built into the system that, the appropriations, the way you get the money that have to be spent, the civil liberties laws, which are good laws to protect people's rights on jobs. But it's almost like you're fighting against this giant blob and people are very skeptical that you can beat the blob. And I think that's an area where we need to be a little bit more open-minded. I'm more open-minded about that because this is what the American people want. When I forget about talking to investment clients, when I talk to people on the ground, people look at the government and they say, hey, government does a lot of great things for me, okay? But I have to worry about my job all the time. I have to operate in a different world. Why should they be operating in a different environment? I just think there's opportunity. And this is also potentially liberating for people in the government. There are really good employees in the government, okay? They just play for a bad team. It's like, let's take a good player on a bad team and let's put them on a better team and then probably you get more productivity out of that person. I think that's exciting. It's a lot of risk. Okay, it's going to be a really messy road.
Yep.
But that to me is interesting.